June 2024. A 50-year agreement that underpinned American global dominance quietly expired. No headlines, no official announcement, no dramatic collapse. The petrodollar system, the arrangement where Saudi Arabia and other oil producers sold petroleum exclusively in US dollars, simply ended. Saudi Arabia confirmed it would now accept Yuan, euros, and other currencies for oil sales. The foundation of dollar supremacy just cracked. Most people have never heard of the petrodollar system, but it's been one of the most important mechanisms of American power for half a century. The agreement forced global oil demand to create artificial demand for dollars. Every country needed dollars to buy oil. This demand meant the U.S. could print currency without triggering immediate inflation because those dollars were absorbed globally. The petrodollar system allowed America to run enormous deficits, fund military operations worldwide, and maintain economic dominance even as manufacturing and production moved overseas. Now it's ending. Not with a crisis, not with a declaration, just a quiet expiration of a 1974 agreement that Saudi Arabia chose not to renew. The consequences won't be immediate, but they're inevitable. As oil trades increasingly in yuan, euros, and other currencies, demand for dollars decreases. As dollar demand decreases, America's ability to print money without inflation diminishes. As that ability diminishes, the entire structure of American economic and military power becomes unsustainable. This is the story of how the petrodollar system was created in the chaos following Nixon's abandonment of the gold standard, how it gave America unprecedented economic power for 50 years, how cracks in the system have been forming as China, Russia, and Saudi Arabia pursue alternatives, and how the June 2024 expiration represents not just the end of an agreement, but potentially the beginning of the end of dollar dominance. Understanding the petrodollar matters because its collapse would fundamentally reshape global power. The United States has been able to run trillion-dollar deficits because other countries need dollars to buy oil and hold dollar reserves. If oil trades in multiple currencies, that need evaporates. The U.S. would face the same constraints other countries face. Print too much money and inflation surges, run large deficits and borrowing costs spike. The special privilege of printing the global reserve currency, what's called exorbitant privilege, disappears. The petrodollar system began with a crisis. In August 1971, President Richard Nixon ended dollar convertibility to gold. The Bretton Woods system, where the dollar was backed by gold and other currencies pegged to the dollar, collapsed. Suddenly, the dollar was just paper backed by nothing but trust in the U.S. government. Other countries holding dollars were furious. They had accumulated dollars under the assumption those dollars could be converted to gold. Now they held paper that could be printed infinitely. The immediate problem was practical. Why would other countries continue accepting dollars for trade if those dollars weren't backed by anything? The answer needed to be something other than gold. The Nixon administration, led by Secretary of State Henry Kissinger, found that answer in oil. If countries needed dollars to buy oil, and every industrialized economy needed massive amounts of oil, then demand for dollars would continue regardless of gold backing. Saudi Arabia was the key. As the largest oil producer and de facto leader of OPEC, Saudi Arabia could establish the dollar as the exclusive currency for oil transactions. But Saudi Arabia had no reason to do this for free. The kingdom wanted something in exchange: American military protection, weapons sales, and support for the Saudi regime. Negotiations stretched through 1973 and 1974, accelerated by the oil crisis following the Yom Kippur War. In 1974, the deal was struck. Saudi Arabia agreed to price oil exclusively in dollars and to recycle petrodollar surpluses into U.S. Treasury securities. In exchange, the United States provided military protection, advanced weapon systems, and political support. The arrangement was formalized through a series of agreements, the most significant being the United States-Saudi Arabian Joint Commission on Economic Cooperation, established in June 1974, exactly 50 years before the system's expiration. The negotiation details reveal how thoroughly the system was designed. Kissinger personally traveled to Saudi Arabia multiple times between 1974 and 1975. The discussions covered not just oil pricing, but the entire structure of the Saudi-American relationship. The U.S. agreed to sell advanced weapon systems, F-15 fighters, AWACS surveillance aircraft, and sophisticated air defense systems that had previously been restricted to close NATO allies. American companies would help modernize Saudi infrastructure, from oil facilities to cities to telecommunications. The Saudis agreed to invest their oil revenues primarily in U.S. dollar assets, especially Treasury bonds, but also American real estate, stocks, and businesses. This recycling mechanism was crucial. If the Saudis simply sold oil for dollars and immediately converted those dollars to other currencies, it would undermine the entire system. By keeping revenues in dollars and investing them in dollar assets, the petrodollar circulated back into the American financial system rather than draining out. The agreement also included a secrecy component. The full extent of Saudi Treasury holdings was kept confidential to avoid revealing how dependent both countries had become on the arrangement. The Treasury publishes data on foreign holdings of U.S. debt, but Saudi holdings were often obscured within broader regional categories or held through intermediaries. This opacity served both parties. Saudi Arabia avoided political backlash at home for financing the American government, and the U.S. avoided advertising how much it depended on Saudi recycling. The mechanics of the petrodollar system were elegant and enormously advantageous for the United States. Every country that wanted to buy oil needed dollars. To get dollars, they had to either export goods to America or hold dollar reserves accumulated through trade surpluses. This created constant global demand for dollars regardless of how many the Federal Reserve printed. As long as oil was priced in dollars, the world needed dollars. The practical operation worked like this. Japan imports millions of barrels of oil monthly. To pay for that oil, Japan needs dollars. To get dollars, Japan exports cars, electronics, and machinery to America. The dollars Japan earns from exports flow to Saudi Arabia for oil purchases. Saudi Arabia then invests those dollars in U.S. Treasury bonds. The circle is complete. American consumers buy Japanese goods, Japan buys Saudi oil, Saudis buy American debt. Everyone needs dollars at every stage. Germany operates similarly. German manufacturers export machinery and vehicles globally, especially to the United States. The dollars earned go partly to pay for imported oil from the Middle East. Those dollars flow to oil producers who recycle them into dollar assets. Europe needs dollars not just for direct oil purchases, but as reserves to stabilize their banking systems and facilitate international trade. The euro exists, but oil pricing in dollars meant Europe still needed massive dollar reserves. Even countries with oil resources often needed dollars. Brazil produces oil domestically but also imports. Venezuela has enormous reserves, but historically lacked refining capacity for certain products. Nigeria exports crude but imports refined gasoline. These countries participated in global oil markets priced in dollars, meaning they needed dollar access even though they were producers. The system trapped everyone, producers and consumers, into dollar dependence. Saudi Arabia and other oil producers received dollars for their oil. Rather than converting those dollars to their local currencies, which would have undermined the system, they recycled them by purchasing U.S. Treasury bonds and other dollar-denominated assets. This meant oil revenues flowed back into the U.S. financial system, helping finance American deficits. The Saudis got financial returns and security guarantees. America got to fund government spending with oil money. The system created what economists call exorbitant privilege. The United States could run persistent trade deficits, importing more than it exported, because other countries needed dollars for oil purchases. Those dollars would return to the U.S. through Treasury purchases, keeping interest rates low. This allowed America to consume more than it produced, fund military operations globally, and maintain living standards even as manufacturing declined. The petrodollar system also weaponized the dollar. Because international oil trade required dollars, the U.S. could use financial sanctions as a foreign policy tool. Cut a country off from the dollar system, and you cut them off from buying oil on global markets. This gave America enormous geopolitical leverage. Countries that defied U.S. interests could be economically strangled through dollar exclusion. For 50 years, this system functioned. Oil was priced in dollars. Global central banks held massive dollar reserves. U.S. Treasury bonds were considered the safest asset in the world. The Federal Reserve could print currency to address domestic problems without immediately triggering inflation because those dollars were absorbed globally. America financed wars, welfare programs, and consumption largely through this mechanism. But cracks began forming. The 2008 financial crisis shook confidence in American financial management. The aggressive use of dollar sanctions against Russia, Iran, Venezuela demonstrated that dollar access was a weapon that could be deployed against anyone. China's rise as an economic superpower created an alternative pole of power with different interests. And most significantly, oil producers began questioning whether exclusive dollar pricing served their interests. China has been the primary driver of petrodollar alternatives. As the world's largest oil importer, China has enormous leverage with oil producers. Starting in 2018, China launched Yuan-denominated oil futures contracts on the Shanghai International Energy Exchange. The contracts were backed by gold convertibility, addressing concerns about yuan liquidity and value stability. China offered oil producers an alternative: sell oil for yuan, and those yuan can be converted to gold if desired. The yuan oil futures mechanism is sophisticated. Oil producers selling to China receive yuan payment. Those yuan can be used to buy Chinese goods, invested in Chinese assets, or converted to gold through the Shanghai Gold Exchange. This convertibility addresses the main objection to yuan, that it's not fully convertible, and China controls capital flows. By offering gold conversion, China provides an escape valve that makes yuan more acceptable to oil producers, wary of being trapped in Chinese assets. China has bilateral currency swap agreements with dozens of countries, allowing direct yuan trade without dollar intermediation. Russia sells oil to China for yuan. Iran, under U.S. sanctions and unable to access dollars, sells oil to China for yuan. Venezuela, also sanctioned, uses yuan for Chinese oil sales. These aren't small transactions. China imports over 10 million barrels per day, roughly half of Saudi Arabia's total production. Yuan-denominated oil trade is already massive, even if not yet dominant. The Belt and Road Initiative extends yuan influence beyond oil. Chinese infrastructure projects across Asia, Africa, and the Middle East are often financed in yuan, creating yuan-denominated debt and yuan trade flows. Countries that owe yuan debt to China have incentive to earn yuan through trade, including oil sales. This creates network effects where yuan becomes progressively more useful as more participants use it, similar to how dollar dominance originally developed. Russia accelerated the shift. Following Western sanctions after the 2014 Ukraine annexation, and especially after the 2022 invasion, Russia began selling oil to China and India in yuan and rupees. This wasn't just political defiance, it was practical necessity. If Russia couldn't access dollar financial systems due to sanctions, dollar-denominated oil sales became pointless. Russia proved that major oil trade could occur outside the dollar system. Saudi Arabia, the linchpin of the petrodollar, started signaling openness to alternatives. In 2022, Saudi officials discussed accepting yuan for Chinese oil purchases. In 2023, Saudi Arabia joined the BRICS group expansion discussions, signaling alignment with China and Russia on economic matters. And in June 2024, Saudi Arabia let the 1974 petrodollar agreement expire without renewal. The kingdom confirmed it would accept multiple currencies for oil sales. The expiration doesn't mean immediate dollar collapse. Oil is still largely priced in dollars due to market inertia and existing infrastructure. But the exclusive arrangement is over. Saudi Arabia can now accept yuan for Chinese purchases, euros for European purchases, or any other currency. Other oil producers are following suit. The United Arab Emirates, Russia, Iran, and Venezuela are all conducting oil sales in non-dollar currencies. When the London gold pool closed in March 1968, there was no warning. Investors woke up, and the market was locked. No gold available, no conversion, done. We created the 7-stage collapse survival guide so you never get trapped when the window closes. It shows you exactly when to move your wealth into assets that survive collapse, before banks freeze, before governments confiscate, before inflation devours your savings, while you can still act. The consequences of petrodollar erosion will compound over time. Reduced demand for dollars means the Federal Reserve faces tighter constraints when printing currency. Print too much and inflation surges domestically because those dollars aren't being absorbed globally like before. This constrains America's ability to run large fiscal deficits without consequences. Higher inflation or higher interest rates become inevitable. U.S. Treasury bonds will face reduced demand. If oil producers don't need to recycle petrodollars into treasuries, they'll diversify into other assets. Reduced treasury demand means higher yields required to attract buyers. Higher yields mean increased debt service costs for the U.S. government. With federal debt exceeding $34 trillion, even small yield increases translate to hundreds of billions in additional annual interest payments. The dollar's reserve currency status erodes gradually. Central banks currently hold about 60% of reserves in dollars, down from over 70% 2 decades ago. As oil trades in multiple currencies, the rationale for holding massive dollar reserves diminishes. Central banks will diversify into Yuan, euros, gold, and other assets. This reduces dollar demand further, creating a self-reinforcing cycle. American military primacy becomes harder to sustain. The U.S. defense budget exceeds $800 billion annually, more than the next 10 countries combined. This is financed partly through deficit spending enabled by petrodollar recycling and treasury demand. As that system erodes, maintaining such massive military spending becomes fiscally unsustainable without dramatic tax increases or spending cuts elsewhere. The geopolitical implications are profound. Dollar dominance has been a key tool of American power. Sanctions work because they cut adversaries off from dollar systems. Military interventions are affordable because deficits are financed cheaply through global treasury demand. Alliances are maintained partly through economic benefits of dollar access. As dollar centrality declines, these tools become less effective. China emerges as the primary beneficiary. Yuan-denominated oil trade increases Chinese currency internationalization. The Belt and Road Initiative creates yuan-based trade networks across Asia, Africa, and the Middle East. China's financial infrastructure, yuan clearing systems, development banks, payment networks, provides alternatives to dollar-dominated institutions like SWIFT and the IMF. As the petrodollar erodes, the petro-yuan rises. The transition won't be smooth or quick. 50 years of dollar infrastructure, contracts, pricing mechanisms, financial systems don't disappear overnight. Most international debt is dollar-denominated. Most commodity pricing uses dollars. Changing this requires building new systems, which takes time. But the direction is clear, and the June 2024 petrodollar expiration marks a formal turning point. Saudi Arabia's decision not to renew the agreement reflects changing geopolitical calculations. The kingdom no longer trusts American security guarantees unconditionally. The U.S. failure to support Saudi Arabia during the Khashoggi crisis, the Yemen war complications, and the Biden administration's complicated relationship with Crown Prince Mohammed bin Salman all contributed to Saudi skepticism about American reliability. Meanwhile, China offers massive investment, technology transfer, and alternative security partnerships. The broader trend is multipolarity replacing unipolarity. The post-Cold War period where America was the sole superpower is ending. China, Russia, India, and regional powers increasingly pursue independent policies rather than aligning automatically with Washington. The economic foundation of American unipolarity, the petrodollar and dollar reserve status, is eroding simultaneously. These trends reinforce each other. Historically, reserve currency transitions are rare and destabilizing. The pound sterling's replacement by the dollar as global reserve currency took decades and coincided with Britain's imperial decline and 2 world wars. The transition wasn't managed smoothly. It involved financial crises, competitive devaluations, and geopolitical chaos. There's no reason to expect a dollar-to-yuan transition would be smoother, especially given the strategic rivalry between the U.S. and China. The Federal Reserve faces impossible choices. To maintain dollar strength and demand, the Fed would need to keep interest rates high, which slows the economy and increases debt service costs. To support economic growth and manage debt, the Fed needs low rates, which risks inflation and currency depreciation as global dollar demand falls. There's no option that solves both problems simultaneously. The constraints that other countries face are starting to apply to America. The American public largely doesn't understand this dynamic. Politicians promise programs and tax cuts simultaneously, assuming deficits don't matter because Treasury bonds always find buyers. This worked under the Petrodollar system. Deficits were financed by oil revenues recycled into treasuries. But as that system ends, the assumption breaks down. At some point, probably during a crisis, the public will discover that decades of deficit spending have created obligations that can't be met without either massive inflation or drastic spending cuts. The average American will experience petrodollar collapse through inflation first. As global dollar demand falls, the dollars circulating domestically have less purchasing power. Prices rise for imported goods, electronics, clothing, vehicles, because the dollar buys less from foreign producers. Energy costs increase because oil priced in other currencies becomes more expensive when converted to weakening dollars. Food prices rise because agriculture depends on fuel and fertilizer, both globally traded commodities. Interest rates on mortgages, car loans, and credit cards will climb. As Treasury yields rise due to reduced foreign demand, all dollar-denominated borrowing becomes more expensive. The 30-year mortgage rate that was 3% becomes 5%, then 7%. Credit card rates that were 15% become 25%. Consumer debt service costs surge, reducing discretionary spending and living standards. Government services face cuts or taxes increase dramatically. The federal government currently pays over $1 trillion annually in interest on the debt. As yields rise, that figure could double or triple. To cover increased debt service while maintaining other spending, taxes would need to rise substantially or benefits would need to be cut. Social Security, Medicare, defense spending all would face pressure. The political battles over these choices will be severe. The dollar's decline won't be uniform or steady. There will be rallies when crises elsewhere make dollars temporarily attractive despite long-term decline. There will be plateaus where the system stabilizes at a new equilibrium before declining further. But the direction is established and the removal of petrodollar structural support accelerates the timeline. The timing of full dollar reserve status collapse is unknowable, but the direction is established. Some analysts predict Yuan parity with the dollar in reserves within 20 years. Others suggest a multipolar reserve system with no dominant currency. A few expect crisis acceleration, a major geopolitical event or financial panic that triggers rapid dollar flight. But virtually no serious analyst expects the current dollar dominance to persist indefinitely given current trends. Alternative systems are being built actively. The BRICS group is developing payment systems that bypass SWIFT. Central bank digital currencies are being designed partly to facilitate non-dollar trade. Gold is being reaccumulated by central banks at levels not seen in decades. Bilateral currency swap agreements between countries allow trade without dollar intermediation. These alternatives individually are small, but collectively they're creating infrastructure for a post-dollar world. The irony is that American policy accelerated the transition. Aggressive use of dollar sanctions demonstrated that dollar access is a political weapon, not a neutral tool. Massive money printing during COVID showed that dollar supply can be increased arbitrarily for domestic political purposes regardless of global consequences. Unilateral foreign policy decisions undermined confidence in American reliability as a partner. Each action had short-term domestic benefits but long-term costs to dollar primacy. The petrodollar's ending doesn't mean immediate collapse, but it removes a structural support of dollar dominance. Oil demand created dollar demand. Dollar demand allowed deficit spending. Deficit spending funded consumption and military power. That circular flow is breaking. Oil will still be traded, but in yuan, euros, dirhams, and eventually digital currencies. Each transaction that occurs in non-dollar currencies is one less transaction creating dollar demand. You're witnessing the slow-motion end of American economic hegemony. The process began before June 2024 and will continue long after. But historians may mark the petrodollar expiration as the moment when dollar dominance became definitively temporary rather than permanent. The United States will remain powerful. It has enormous resources, technological leadership, and military capabilities. But the unique advantage of printing the global reserve currency, of running unlimited deficits without consequences, of weaponizing currency access, that advantage is eroding. The question isn't whether the petrodollar system is ending. It is. The question is what replaces it and how chaotic the transition becomes. A managed decline where dollar reserve status gradually diminishes while alternatives rise smoothly would be the best outcome. A crisis-driven collapse where confidence breaks suddenly and capital flees dollars would be catastrophic. The most likely scenario is somewhere between a bumpy transition marked by periodic crises, policy mistakes, and geopolitical conflicts as the old order dies and the new one struggles to be born. This is Decoded Economics. Subscribe to see the collapse before it happens.